Hi, my name is Cassie and I'm here with Ethan and Jake. We're going to tell you why CheckPoint Software Technologies is a good company for you to buy right now. CheckPoint Software Technologies is an international provider of software and hardware. It was founded in 1993 and is headquartered in Tel Aviv, Israel. To get to know a little bit about this company, they provide combined hardware and software products for IT security, including network security, endpoint security, data security, and overall security management. And I'll get into that in a little bit to explain more. CheckPoint provides a wide variety of products and solutions to a number of different industries, ranging from healthcare to governance, risk and compliance, and to private and public clouds. Their strong, well-developed products that set them apart from their competitors include next-generation threat prevention, mobile security, next-generation firewalls, security management, and data security. One of the most unique attributes offered by the company is their single management console and flexible software blades. Both of these products are tailored to the customer and made with the customer in mind, which really builds CheckPoint's strength. It's important that products are easy for a customer to use and to understand, and that they continue to evolve so that you can add on, which is the flexible software blades, especially as threats are continuing to develop, which I'll talk about more next. CheckPoint's Sandblast zero-day protection software catches more malware and is focused on proactive prevention, and again, it focuses on a complete integrated protection so it's easier for the customers to use. And so you can see here what this software allows for the ability to see live attacks on this world cyber threat map, and this is just a single instance of a moment that it was captured, but if you go and look at it, you can see that it's updated and you can watch the attacks happen live. And this is important because hackers are constantly modifying their strategies and techniques so that they can't be detected, but with the software that CheckPoint offers, it keeps it updated and easy, not only updated, but also easy for a customer to use so that they can understand what the modified strategies that need to be combated are. Additionally, this software was recently chosen by Boston Properties to secure 45 million square feet of office space, so you can see how this software is being used currently.
Looking at the IT security market, we see three big players. Those are Symantec, McAfee, and CheckPoint Software. So Symantec has about 18.4% of the market share with a PE ratio of 20.3. It was founded in 1982, and recently its revenue has been decreasing due to concerns because it itself was hacked in 2012 and some of their products have not detected malware. The second company is McAfee, which in 2010 became Intel Security when it was acquired. It has about 16.4% of the market share. McAfee was founded in 1987 and then bought by Intel in 2010. The third big player is CheckPoint Software, which has 7.4% of the market share. It was founded in 1903, and many other companies spread out to create the rest of the 57.8% of the market. So this shows that CheckPoint Software doesn't currently have the largest market share, but especially with Symantec having its problems, its market share is definitely destined to grow. Let's take a look at the performance of the IT security market over the past few years. Throughout the last 5 years, it has increased annually about 3.4%. And with the increased sales of computers, cell phones, and tablets, there's an increased need for this security. This year, revenue is expected to grow by 0.9% to about $10.4 billion. And over the next 5 years, it's expected to have solid growth of about 1.7% annually to reach about $11.3 billion in 2020. What is it that makes IT security such a growing need? Recently, there have been many incidents that have required IT security and shows what problems there are right now. So the first one is the one with Target Corporation. So in December 2013, hackers stole credit and debit card records from over 40 million Target customers. And when this was announced, traffic in sales for Target took a large hit and dropped the quarter's profits by about 46%. The next one was JP Morgan Chase. which happened between July and August of 2014, in which a series of coordinated attacks infiltrated JP Morgan's computer networks. The account information of about 83 million households and small businesses were compromised, but luckily no sensitive information such as social security numbers were breached. In fact, those same hackers that hacked JP Morgan Chase tried hacking multiple other financial service companies as well. And most recently, in 2015, there was the Anthem Incorporated incident, in which hackers breached a database that housed at least 80 million records of current and former customers as well as employees. That database included names, social security numbers, addresses, and income data. So this shows that with the large amount of incidents occurring, that there is a much bigger need for IT security and a much bigger need for CheckPoint software. Now let's take a look at the breach level index report from 2014. The breach level index report shows the number of breaches as well as how constant they've been throughout the year. So in 2014, there were 1,023,108,267 records breached. That's on average about 2,803,036 lost or stolen data records per day. There are about 1,541 breach incidents, which was a 78% increase in the number of breaches from 2013.
The next area of analysis that we looked at was within competitors to CheckPoint. We don't necessarily have the best direct competitors to look at, but we wanted to incorporate software companies of equal size, such as Juniper in their market cap. We also have a large cap company in Cisco, and then we also have a smaller emerging company in Fortinet. We believe that these give a great financial perspective as to where CheckPoint is within their ratios. The first area of financial analysis that we looked at was in management effectiveness, which encompasses return on equity, return on investment, and return on assets. All of these, compared to the other companies, CheckPoint was definitely by far the best. First off, return on equity measures a corporation's profitability by how much profit a company generates with the money shareholders have invested. And CheckPoint is right around 19%, which is significantly above its competitors. The next one is return on investment, which is a performance measure on how efficient a company is in their investment practices over a different number of investments. Again, 17.1% is above its competitors. Return on equity and return on investment are a more proficient and a better metric to look at, especially with software companies, because they're not necessarily investing assets within their companies rather than investing their time and money into developing the best type of software. Even though return on assets isn't as big of a metric, it still is better than its competitors. After looking at management effectiveness, we wanted to highlight some of the most important ratios and margins that surround a company's financials, which are price to earnings ratio, earnings per share, and profitability. With the price to earnings ratio, it is essentially the ratio of valuing a company that measures its current price per share relative to its per share earnings. So the first line is CheckPoint. The second line at 14.78 is Cisco, and the last one is Fortinet. And we also looked at the industry average, which was at 20.01. So CheckPoint is a little bit above the industry average, which might necessarily be the best investment for someone who is a value-added investor. But if you look at its other financial information, such as in the management effectiveness, we believe that that can outweigh some of that value investor side beliefs. Additionally, in 2015, CheckPoint had a share buyback program because they believed that their shares were undervalued. This also has an effect on price to earnings, but we believe that that data and that the company really believes in itself really holds true. Moving forward, we looked at profit margin analysis. Essentially, this is the bottom line. This is where the company proves itself. And by looking at this this graph, it's pretty obvious to see that CheckPoint does a really good job with this. Looking at their gross profit margin, they're significantly higher by 15 to 20% above its competitors, as well as their operating profit margin, and then ultimately the net profit margin, which is the most important metric, is significantly higher, double than Cisco, which is the large, big player in the market, and additionally, it's also a little bit under 50% of what the gross margin is, whereas everyone else is at 30% or even less than that. Additionally, the industry average is 22.23, and we're about double that. Again, having a really great profit margin means that they're handling their expenses and overhead extremely well. Lastly, we looked at earnings per share, which is the portion of a company's profit allocated to each outstanding share of common stock. And again, CheckPoint is doing a great job to its investors at $3.64 per share, which is significantly higher and almost double what Cisco and blows away Fortinet and Juniper. So again, stronger than its competitors and also gives back to its shareholders really well. Additionally, when doing a financial analysis on a stock, you have to look at risk. So two big ratios that we looked at were the debt to equity ratio and the current ratio. Debt to equity is a debt ratio used to measure a company's financial leverage. And the last year, the ratio was 0.36. So according to Investopedia.com, debt to equity ratios that are lower than 0.4 are considered better debt ratios in which companies can leverage a little bit easier than companies that have higher than a 0.4 ratio. Additionally, we looked at the current ratio, which is a liquidity ratio on a company's ability to pay short-term and long-term debt obligations. CheckPoint falls sort of in the middle of the road. A stronger, Cisco and Fortinet are definitely a little bit stronger, but again, it's still in line with where it should be. Lastly, I also want to look at a qualitative view on the companies and its competitors. So when looking at Cisco or Symantec, they have a very competitive product mix compared to those companies in terms of what solutions they can provide to their clients, and this is right in line with where they should be. Additionally, CheckPoint has a really long outstanding history of being in the market for 22 years, which definitely gives itself a great brand value and brand name. Now, looking at cons, they've had some major breaches, such as in their technology at JP Morgan Chase, as well as in Target, which definitely tarnishes some of their value and credibility. But we've seen that after that breach, they've been able to continuously improve themselves and ultimately make themselves a better buy.
Overall, we recommend that you invest in CheckPoint because of their superior technology, which, as I explained earlier, it's consumer focused and it's constantly evolving so that it can meet the growing demand. As hackers are constantly modifying their strategies, the demand is ever increasing. The IT industry is seeing more demand, and CheckPoint is providing the products to meet this demand. And not only are they providing the products to meet their minimum, they're providing products to go above and beyond that are easy to use, they can constantly be added onto, and easy to see what needs to be done. And also, even they have high profitability. Even though the stock is a little bit expensive right now, we believe that these factors, in combination with the already strong financials that were discussed, put CheckPoint in a position to see above average returns in the coming years.